Out of steam on these equities. We've had 20 records in a row. Lululemon plunges domestically here. The business under pressure. Tesla also down as they're potentially going to cut production in China. So for the moment, 5,300, big round number. Right now, this market has exhausted itself for the week. But let's see how we finish at the end of the day. Some other asset classes for you. Rounding out a pretty big week where the Fed has indicated they will cut 3 times. That gives you a bond market. There is no barrier to entry here. 420 is where we trade. We're down 6 basis points. We've moved overall down by about 9 on the week. The Bloomberg Dollar Index, you're looking at the dollar actually on the week up 0.7%. It's set for its best week in 2 months. So again, the steadying of the nerves and the rate cuts, etc., and the uplift to growth has emboldened the dollar. Bitcoin, I just thought we'd give you a flash there. Again, down over 2%. At one juncture, we were down 10% this week. This has been the worst week for Bitcoin of 2024, and it still looks overbought, according to JP Morgan. Tesla's down by 3%. It's certainly one of the stocks we will dig into. When it comes to what to watch, we've got athletic retailers Lululemon and Nike, both under pressure, posting disappointing outlooks for slightly different reasons. Abigail Doolittle is with me to differentiate.
Well, on the surface, both of these retailers put up pretty good quarters, Manus, but beneath the surface, not so much. And right now we have Nike falling to its worst day since December. Lululemon down 14%, the worst day since March of 2020. So that's the degree of selling pressure. Starting out on that one, they beat again on the quarter, but the sales outlook is seen as being pretty cautious. $10.7 billion to $10.8 billion. That's the range for this year. That's growth of 11% to 12%. When you compare that to last year of 18%, it's just not cutting it. This stock now down sharply on the year. On Nike, they are feeling the heat from some of the new running sneaker companies such as Hoka. They warned that sales will fall to the low single digits this year, this fiscal year that starts in June. Analysts had been looking for a 4% rise in the first quarter, 6% rise in the second quarter. CEO Donahue is saying that there are important adjustments ahead. This as they shift away from some of their more classic styles. Both of these stocks, Manus, now down 10% or more year to date.
Yeah, we're just looking at Lululemon. I'm just looking at this, down 15% at the open. That's the biggest drop since 2020. A brutal day there. Abby, thank you very much. Turn to the biggest, well, the newest public company, I should say, not the biggest. Reddit shares coming back to earth this morning after successfully debuting on the NYSE. It is the 4th largest US IPO this year. Ed Ludlow is with me from San Francisco. Ed, I mean, this was stellar. 70% on the open, 48% up on the close. It's just a moment of redressing the balance.
Yeah, I mean, I wrote about in my column today on Technology Daily that they got their AI story right. And I think coming out of the one-day listing or day one of listing, that's what people are talking about. We're pulling back 3% day 2, but this is still a company based on the shares outstanding, valued at $8 billion, fully diluted basis around $9 billion. That's lower than its last private round in 2021, which was a $10 billion valuation. And it's going to be interesting in the days and weeks ahead to see who played the IPO. So, for example, we know that Cathie Wood and ARK bought Reddit shares for 2 of their exchange-traded funds. 8% of the offering went to Redditors themselves without any lockup or restriction. But there are some lockup and restrictions on some of the longer-term shareholders. How will that play up in the next few weeks and months? And I go back to that AI story. You know, it's everything that the executives wanted to talk about, but it's a very nascent business. And I just reflect in the column, and I'm giving myself a shameless plug, but go and read it on Tech Daily, that if you look at the listings of the last 6 months, whether they are a social media platform like Reddit, an AI adjacent story rather than a true pure play AI story, they're talking it up, and in the first instance, investors buy it. There's no real sell-side coverage yet on Reddit, which you'd expect, but I would note that the New Street Research cautioned that the FTC is already probing the Reddit business to license its data for the use in training large language models. And while they think that will have a muted impact, it could slow down the pipeline of deals with other AI companies that want to harvest that data. So it's been a fun week, Manus. Happy day 2 post-Reddit IPO.
Indeed. And it is expected to grow by 20% this year, as you say. They face some of the challenges in dealing with our data when you are a contributor on there. We're looking forward to your daily newsletter. Ed Ludlow there in San Francisco. Let's turn our attention to the EV market. I just said to you at the open, Tesla stock was having a tough day for the second day. We understand they're going to reduce production in China due to slowing sales growth and intensifying competition. Alex Webb is with me. It's almost like a weekly laundry list of either price cuts, factory outages, union angst. Alex, contextualize growth of EVs in China overall. I mean, this is about competition from BYD at the very heart of it.
Yes, not just BYD, but a range of other Chinese EV makers as well. The Chinese market actually, unlike much of the rest of the world, is growing at a fairly healthy clip, 17% or so. Tesla itself is shrinking. The first 2 months of the year, Tesla's sales in China fell by 6%, according to numbers released locally. About half of the output of this factory in Shanghai goes to the Chinese market. The Bloomberg reports from its sources that the production is going to go from 6.5 days a week to 5 days a week. The thing that's interesting about this is it seems to herald a bit of a strategy shift. Last year, when Tesla started to see this weakness in the EV market, it started really pushing discounts in order to drive its numbers up. Don't forget, Tesla massively expanded its capacity in recent years with new factories in Berlin, in Texas, and of course in Shanghai itself. In order to fill that capacity, it really started discounting in a big way. This might signal a bit of a pivot, that they are instead looking to cut costs, cut some of their production costs. If that extends to other facilities as well, that would be very interesting and something investors would have to take on board because it heralds a different kind of strategy.
Okay. Alex, thank you very much. Alex Webb on the Tesla move. Let's pivot to FedEx. They're recording the biggest rally in over a year, and this is all on the back of a $5 billion share buyback program, cost-cutting efforts that are beginning to pay off. Simone Foxman is with me. This is a battle between current delivery and future promises on cuts, isn't it?
Yeah, I mean, really this was meant to be a verdict on FedEx's broader cost-cutting plan, and analysts really cheered by what they're seeing so far. Remember, this plan meant to restructure the delivery network. They've lost about 22,000 jobs in the last year or so. Efforts to turn around the express business. Analysts largely saying this delivered, and when we dive into the numbers, we'll see earnings topped expectations by 40 cents, coming in at $3.86 a share. Revenue, however, slightly short of expectations at $21.7 billion. All of this, though, despite some weather-related disruptions back in January. Raj Subramaniam saying, we are making meaningful progress on our transformation. He said there were permanent cost reductions of $1.8 billion. But analysts, despite this rally we're seeing today, flagging some concerns. Morgan Stanley pointed out potential earnings quality issues. Jeffrey said volumes were softer than expected in the ground, even though that's really the way the business is moving. But we are seeing gains here today on an intraday basis. This stock up the most since March 17th, 2023, Manus.
Go FedEx. Simone, thank you very much. Well, stocks are poised for their best weekly gain of 2024. DWS's Group's David Bianco weighs in on the rally saying this. Last week, we raised our S&P 500 price target to 5,300 as it's parenting AI. This includes a 15% premium for superior growth potential of digital stocks. David, good morning. Good to have you with me.
Good morning.
There's no doubt about it. There's an sense of exuberance, 20 records in a row. Contextualize what you think AI will grow at. I was looking at what UBS are saying. They expect 18% earnings growth in tech-related stocks this year, and over the next 5 years, about 70%. Does that lay perhaps the firmest foundation of all for Mag 7 and tech in general?
That's right. So AI is real. It's going to help the S&P grow. It's going to help the economy grow. We're still wrestling with valuations, and wrestling with valuations always requires some degree of consideration of interest rates. So what a week it's been, because we've got the Fed on one hand and AI, the theme, the stocks, still reigning supreme. We do think that we're going to see earnings growth out of the S&P 500 this year and next year. We're not very worried about a recession anymore, but but we're still of the view that overall earnings growth for the S&P will be about 8% this year and next year. And that is with tech and digital stocks, the AI stocks especially, doing more than 20% earnings growth this year and next year. The valuations expect every bit of that. And if longer-term Treasury yields go up, then the valuations become even more demanding. So we've got a Federal Reserve that is signaling that it's patient about inflation coming down to its target. We'll see how patient the long-term bond market remains about that. Those who want to be optimistic about inflation solving itself, or even the deficit solving itself through productivity and the supply side being strong, and pointing to things like AI, I would say to you, look, even if you believe in AI, these things take time. They'll play out over years. And what you've got going on in the equity market is tremendous wealth creation on rapid PE expansion, on the promise of what will come in the years to come.
So then,
Yes?
let's just pause. There's a lot to unpack there. So
That's right.
so much then is front-loaded, isn't it? It's on the presumption of future
That's
earnings.
exactly right.
That's your job. Your job is to presume where the earnings are going to come from. But if tech is so front-loaded, is that what leaves you at a 5,300 call for this year? Relative to some others. For example, SocGen at 5,500. There's a few other outliers up there, but that seems to be the top of where it is. Is 5,300 a conservative call for you? Are you playing catch-up?
We are playing catch-up. We've been keeping up thanks to good stock selection strategies overall, and our portfolio managers doing a good job of it. But we've been a bit cautious on the macro front from a combination of demanding valuations, and not everything's exactly rosy outside of the tech and digital AI world. That said, it's hard to get ahead in this market without taking even more concentrated bets on the leadership and the momentum that's dominated for so long. That's the situation we've been in. We're doing our best to manage around it, point to alternatives. We like healthcare, we like financials, we like small cap stocks. We want to pick out of these parts foreign stocks. Shorter duration bonds are offering still an attractive yield. We're doing our best to keep up with great large cap U.S. equity markets while recognizing that the promise of AI is real, but don't overly count on it or
it almost sounds like you're fighting with yourself. It almost sounds like you're fighting with yourself in that you're looking for...
And we are. Yeah.
You know, you're looking perhaps at Europe, which is on a magnificent run. Japan, which is on a... I don't even have the superlative for Japan. But are they hedges,
we're pointing to those,
or are they active participatory positions?
They offer diversification, but they also offer attractive returns in our view, and we've pointed to things like Japan and foreign stocks. But it's hard to keep up with the AI leadership.
Yeah.
And often people come back to us, our clients, and say, that's all great, but what about the Magnificent Seven? What's your view? Our view is overall fully valued. There are still stocks within even that terrific group that we like and some that we're cautious on. But the point is this. I think too many people are saying the Fed gave a green light, but I would argue that the Fed's trying its best to ignore the equity market. And if the equity market continues on this pace, it might be the equity market giving the Fed a bit of a red light, because this wealth creation is what's flying against the Fed's efforts to be restrictive and get inflation down faster, and it should get it down faster. And if this equity market keeps rallying, even if it's right to do so over the longer term outlook of AI, I don't think that's going to help the Fed in its battle this year or even next year, and I think the bond market's going to lose patience soon.
You know, to a certain extent, the equity market ignored what the Fed said. They raised the longer-term neutral rate, albeit incrementally by a small amount. They penciled less cuts for next year than the market had originally anticipated. They upgraded growth, and they upgraded inflation as well. So who's paid the least attention, the bond market at the longer end or the equity market?
It's hard to do nuance right now, either for me or the Fed or reading the equity market. I agree with you. I mean, if you look at the details of the dot plot, they're trying to signal that they might not cut as fast or as low as previously thought, and that has a lot to do with recession risk diminishing. But no one, is paying attention to those details. The headline has been they're going to cut 3 times this year. Market should rally, but the bigger issue is really is AI, the right valuation, and when do we see that supply buy-side miracle really delivering, not just for these tech companies, but for the economy and the broader corporate world overall.
David, who am I to interrupt a magnificent party on a Friday afternoon? Yields are dropping. Equities are merely pausing for thought. David, thank you so much for being with me this morning. Speaking of which, we're going to talk a little bit more about the Reddit IPO.
This whole process has made us a better company, and we're prepared to be a public company. I think it's actually been really good for us.
We'll get a little bit more on that stock debut in just a moment. The stock gives slightly back, down 7% at $47 and change.
This whole process has made us a better company, and we're prepared to be a public company. I think it's actually been really good for us. And I think companies that, can go public, it's sort of a duty. It's part of the, process of maturing as a company.
Reddit gets a warm welcome from investors. The shares soared at the close 48% yesterday, above the IPO price of the debut, with AI at the center of the social media's proposition and value proposition. The IPO is the fourth largest this year in the United States, and it marks a rebound after two of the slowest years in a decade. We'll bring in Bloomberg's Amy Orr on this story. So Reddit, a great deal of excitement around it. The insiders got to sell a bit of stock, nearly $300 million. It really blew the doors off at the opening, didn't it?
Yeah, I did. And it seems like it's still holding, even though it's giving up some of the gains in pre-market, but it's still well above the $34, which is very important for a lot of people, especially issuers coming forward in the second quarter. A lot of people were just concerned whether Astera Labs is the only exception to the rule, and then whether it's got all the tailwinds behind it, the AI leaning, the microchips and all, and whether Reddit will actually enjoy the same kind of investor reception. And it seems like it does.
What's the pipeline like? I want to make sure that you're busy for the rest. I want to make sure that you're busy for the rest of the year. You've got Instacart, you've had Astera Labs. I mean, you've had momentum shifting. Will it hold? How does the pipeline look? What are people saying to you?
So the pipeline has always been strong, like given that Reddit has been in the pipeline since 2021, and there are a lot of companies in the same boat. And many of them have been continuing to update their filings to make sure that people understand that they still have the intention to go forward. And there are quite a few of those going forward as well. And then, but the pipeline, even though it's very strong for the people who can actually go out in the second quarter, it's still maybe a dozen or so. But I have to say, the moment that Reddit traded and by the minute that it held above its IPO price, like the pipeline just grew longer and longer.
Well, it certainly gives people confidence, but there's also a dynamic that private equity are perhaps being a little bit more under pressure to give the spoils back to some of their original investors so that they can invest again with more significant size at play. How much of that is going to play into the thinking of those when they go to pull the trigger?
So private equity has held a lot of assets, and they've been kind of stuck with these assets for quite some time. And then in the secondary market, since the beginning of the year, we've seen quite a lot of sell down, which means they really wanted to return money to their own LPs. And then, but the only thing though is for private equity assets, many of them have quite a bit of leverage, and that's what investors do not like. They want the proceeds to be used to develop the company for further development, to boost the income and revenue of the company instead of paying their sponsors. We've seen BrightSpring at the beginning of the year. It was the first IPO to come. It was owned by KKR. And it's still, the pricing right now, it's still being kind of hampered by investors' lackluster kind of reception towards it.
Amy, thank you very much. As we see Reddit giving just a little bit back in first flush on the second day of trading. Let's get into the sector price action. Abigail Doolittle is with me as ever, side by side.
Well, on the day, Menace, we are looking at a small decline. The S&P 500 down about 0.1%, helping out to the upside. The communication services sector up about 0.7%. Google higher there. We also have some of the defensive sectors, utilities and healthcare higher. Industrials up slightly. Consumer discretionary, not surprisingly, the worst sector, a big drag, down 1.1% on those disappointing quarters out of both Nike and Lululemon. I should say not disappointing quarters, disappointing outlooks. As for the week, it's a different story. All 11 S&P 500 sectors are higher. The index itself up about 2.5%. And communication services, well, that's the best, up 4.7%. Industrials, the second best, up 3.4%. The worst two sectors still higher, up about 0.7% and 0.6% respectively for healthcare and real estate. So some of the breadth that people have wanted to see for the market rally this week, that is certainly happening as all of these sectors participate in the gains.
Abby, thank you very much. Great work this week. Coming up on the show, we'll set the agenda for you with your trading diet. A little bit of Fed speak today. check in on your trading diary in just a moment. It's worth refreshing our view. This is a break of trend, 20 records in a row. You are just seeing Lululemon down. The footfall in the shops here in the United States is lower than estimated. Internationally, not doing too bad. Likewise, Tesla down. As we understand, they're cutting production. So for the moment, this is bullishness interrupted. In terms of the trading diary, this is what you need to know for next week. Monday is the deadline for Donald Trump's $454 million bond. What will happen? The Milken Investor Conference kicks off on Tuesday. Then we understand how the housing market in the United States looks. The U.S. mortgage applications come in on Wednesday. Thursday, it's Sam Bankman-Fried's scheduled sentencing in New York. And finally, ending the week with the U.S. PCE, all important, and the Fed Chair Jay Powell. The markets will be closed for Good Friday. You can, of course, trade Bitcoin vicariously trading risk. There's a thought for you. That was Fed Week on Countdown to the Open. I hope you enjoyed it. Do join us next week. We'll leave you with the rest of the team to take you through the rest of your trading day. And Mr. Bostic speaks a little bit later on. We've got it all here on Bloomberg.
We are 30 minutes into the U.S. trading day on this Friday, March 22nd. Here are the top stories we're following. A rough day for retail. You have shares of Lululemon and Nike plunging this morning after a weak showing on the earnings stage, with both companies delivering cautious outlooks. Meanwhile, a banner day for social media platform Reddit, which surged nearly 50% in its trading debut on Thursday. We'll recap the action and discuss where the stock goes next. And finally, checking in on the C-suite, Simon Freakley, CEO of global consulting firm AlixPartners. He joins in just a bit to discuss what's weighing on the hearts and minds of chief executives. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets on this Friday, and it's pretty quiet behind me, but it is a down day so far. Of course, you take a look at the S&P 500, currently off less than 0.1%. I think we can go ahead and call that unchanged. It's a little bit more dramatic, of course, if you take a look at big tech, with the NASDAQ 100 currently off by about 0.1%. And I threw the Philadelphia Semiconductor Index on there just for fun, and it's pretty much the same story, of course, down by about 0.1%. So pretty quiet on the index level, but you do have athleisure brands breaking a sweat over the strength of the consumer. Nike and Lululemon both anticipating challenges in the U.S. market. You've Nike warning investors that sales will take a hit this year with pressure, particularly in the sneaker department. Meanwhile, Lululemon seeing a sales slowdown to start the year thanks to lower foot traffic and, of course, shopper pullback. Poonam Goyal of Bloomberg Intelligence joins us now, and I want to start with Lululemon because we are looking at a titanic move in the shares. Give us some perspective here. Was it really that bad?
No, the results were actually very good. I think it's the guidance that has investors concerned. The slower start to 1Q with traffic much weaker than expected, and also conversion down, which means that they need to improve the product and there's something going on there. So we think that's what's causing some of the downside that we've seen today. But I do think as they improve product and they move forward, Lululemon is a strong brand, and we do see their power of 3x2 strategy able to drive their target to double sales ahead of time.
Yeah, so maybe a light at the end of the tunnel there. It's pretty amazing, though. Shares currently down by the most since March 16th, 2020. Of course, that was a pretty bad day, as you can imagine, right in the onset of the pandemic. But let's move on and talk about Nike, because it seems like it's a little bit of a different story, of course. You look at what Nike said, saying that sales will actually decline by the low single digits in the first half of the fiscal year, Poonam.
Yeah, so the near term for Nike is definitely very choppy, but they also did say that sales will turn positive in the second half of their fiscal 2025 and end the year on a positive note. I mean, from what I read from here is that Nike's going to have challenges in the near term to position itself once again for the longer term. They need to focus on innovation and product to drive longer term gains and also maintain their brand lead. It's a $50 billion brand, and it needs to step up their game on innovation.
Absolutely. Competition is growing for Nike. You have the likes of Hoka and some of these other sneaker brands really stepping up to the plate. I'm sure we're going to be having this conversation again soon. So our thanks to Poonam Goyal of Bloomberg Intelligence. Let's broaden out and take a broader look at these equity markets. We have the perfect guest to do that, because joining me now is Greg Bowdle. He is head of U.S. equity and derivative strategy over at BNP Paribas. Greg, happy Friday.
Likewise, thank you.
Let's talk about your year-end price target for the S&P 500. The last clocked in at 5150. You take a look at the S&P 500 right now, we're trading about 100 points above that. So what happens next?
Yeah, I mean, really at the moment, it's just this story of continued momentum. There's been little in the data, or there's been little from the central banks that has really caused the market to pause. So I think generally bottom up, the earnings news has been good this year. The monetary policy environment remains pretty benign, and the macro data has been benign. So far, momentum is the story for U.S. equities.
I mean, you add it together, and are you going to raise that price target, or take us into what that strategy and what it actually goes into formulating a target?
Yeah, so I think the things which make us a little bit more cautious about the market are the valuations. U.S. equities look expensive on pretty much any metric that you choose to look. And positioning, we think there's been an awful lot of money put to work into equities at the back end of last year and the start of this year. So underlying, we do think there's a bit of a fragility. But neither of those two things we think are triggers for a correction. It's the marginal news flow that tends to set the tone directionally. And at the moment, that has been positive. So, if we remain in an environment where the news flow is good, the Fed remains dovish, corporate earnings are strong, then we we could continue to trend higher. We may have to think about edging that forecast higher. But the important thing when we set that forecast was we said it was a modally most likely outcome, but we do feel that there's a little bit more left tail risk than right tail risk here, given those forces I mentioned.
Well, it's pretty amazing. You look down the list of course, Wall Street year-end targets for the S&P 500, and there's a lot of four handles still, which really speaks to just how quickly this market has moved. So maybe you're not anticipating a correction, but would you anticipate some sort of pullback, just given the valuations, that maybe we take a breather at some point?
No, I do expect that we will take a breather and we'll have a pullback at some point, but the at some point part is the hard part to gauge. So, as I said, valuations and positioning are the things that make us more cautious, but those don't tend to act to triggers. So we've just got through a kind of a big event for NVIDIA this week. We've got through a big event for the central bank. We now have a little bit of a kind of lull in terms of data points, I think, before we get properly into the next earnings season in a couple of weeks. Assuming that's benign, then we really don't see the trigger in the first half of the year, but I think any signs of cracks and the price action could be pretty asymmetric.
Let's talk about what's going on between benchmarks right now, because we've been talking about the S&P 500, of course, the 500 plus biggest names in the U.S. stock market. It's been outperforming as of late the NASDAQ 100, your big tech benchmark, which is sort of a flip in the relationship there. Usually you have big tech leading. You take a look at that change in leadership. Do you think that that's sustainable?
I think possibly. I think is one of the things that we've spoken about previously is that you do need some broadening out of the rally. It's hard for it to be led by a handful of stocks in perpetuity, so we have seen a few signs of that. But certainly under the surface, there's been very large amounts of rotation, dispersion, low correlation between stocks. Even within large cap tech, if you look at the Magnificent Seven, there's really diverging stories driving that. So this idea of rotation, I think, continues. At the start of this year, we suggested that we felt equal weighted S&P could be an interesting place to hide away from some of the highest valuations. But we're also pretty cautious about the other end of the spectrum, where we see something like the smaller mid-caps that have performed well this year with the dovish central bank message. But we're a little bit cautious about the kind of medium-term outlook for those small compras.
I do want to talk about some of those smaller names in just a bit, but let's talk a little bit more about the Magnificent Seven, because that's really all we do. You mentioned that we have seen some dispersion in that grouping. I mean, you have Apple, Tesla kind of fallen out of bed this year. If I were an optimist, couldn't I say that that's a healthy thing to suggest that correlations aren't just at one across the board?
No, I think low correlation is something we typically associate with a bull market environment of relative winners and losers. But a normal environment where you have a bull market and you have low correlation is some outperformance, some underperformance. What we have here are stocks that are up almost 100% year to date and stocks that are down 25% year to date. That, I would argue, is less healthy and less sustainable.
Less healthy, less sustainable. I mean, in the same way that you have valuations really kind of putting a restraint on the market, you think about this big falling out of bed again, that we're talking about the names of Tesla, for example. How much is that going to restrain the market when you think about just the heft of some of these companies that we're talking about?
I think that it won't restrain the market whilst there's a counterweight at the other end. So whilst we still have some very large names performing very well, then it doesn't necessarily become too much of a weight on the market having a couple of names underperform. I think the interesting thing there is what is the differentiation between the names that are performing and outperforming. And I don't think it's random. I think there are some underlying trends there. We've heard you talking just now about a couple of the retail names having some difficulties this morning. And when we look at the names that are down year to date in the Magnificent Seven, they are more consumer-facing stocks versus the AI investment thesis that is really driving the stocks that are outperforming there.
Right, it's a good point. It's not like NVIDIA is selling its chips directly to individuals. Greg, hang tight for just a couple of minutes. We want to take a quick look at what's moving underneath these markets. We're going to do that now with Bloomberg's Jess Menton. And Jess, tell me about what's going on with FedEx.
Well, that one, people keep their close eye on that because, as you know, Katie, it's a big read when you're thinking what it means for the global economy and especially how that company is holding up. And in particular, when you're looking at that stock up about 8% today, this morning, on pace for its best day since June of 2022. So if you're looking at this company, as we know, has been going through so many different cost-cutting efforts, especially over the last 18 months. And through this, you're beginning to see that price supported there, but particularly because it announced a $5 billion buyback plan. Again, this isn't executed just yet, but when you do typically see that, as you know, Katie, that does typically support the stock price when you do see companies roll something like that out.
Big time. I mean, you take a look at FedEx shares currently up about 8% 8%, certainly having a better day than Lululemon. So that, of course, is the FedEx story. Take me into the world of big tech right now.
Of course, and I have to start off with what's happening with Apple here, because all eyes on that, especially after it lost more than $100 billion in market value yesterday. So if you look at this, the Wall Street Journal actually reporting here that it's in preliminary discussions with Baidu over in China because of their generative AI technology, specifically with its devices in China. When that report came out in pre-market trading, you initially saw shares of Alphabet fade on that because, you know, Katie, we've done so many different earnings stories when it comes to Alphabet, and obviously its search engine when it comes to Google, and the competitiveness when it comes to what's happening with AI there. But if you look now, actually some of those shares, when you are looking at Google in particular, have come back. But again, even Apple before this report, it has been under regulatory scrutiny when it comes to the Justice Department here in the U.S. as well as over in Europe. But we've seen this time and time again with big tech companies, and in particular Apple stocks actually already been in a correction here, down over 10% since its most recent highs, and actually clearly underperforming the broader market. So it's been pressured, and a lot of traders I've been speaking with in recent weeks were actually trying to trade it after it fell below that 180 level. But, you know, it's been so hard for traders to try to short any type of company, especially those that got burned because of what happened, obviously, with NVIDIA last month with their blockbuster earnings report once again. But that is a stock that it was already under pressure coming into today.
Yeah, absolutely. I will say Apple investors probably breathing a sigh of relief right now that the stock is at least unchanged. But of course, Reddit has taken all of the limelight this week. But we had another IPO, Astera Labs. Geez, it's just building on these gains.
Right. Don't sleep on Astera Labs. So that actually had its IPO earlier this week, right before Reddit. And our ECM reporters, Amy Orr and Bailey Lipschultz, have been all over this. So I encourage anyone to go to their bio page to read more about this. But this particular company in general, again, in the semiconductor type space, also a technology company, you are seeing that stock, especially heading into today, was up already 70% higher from its initial public offering debut there. So you are seeing that stock supported. And then also when you think of the back of that, also what's happening with Reddit, what it could mean potentially for this IPO pipeline that, you know, has dried up, especially when you have 2 years into the Fed's most aggressive tightening cycle in decades here. What it could potentially mean as the Fed sort of shifts gears, and if we can see, especially in the capital markets front and the IPO front, if we see more companies going public, Katie.
Yeah, of course, that is the big question, because we're not talking about gigantic IPOs here, but as a measure of sentiment, very important. Bloomberg's Jess Menton, thank you so much. And coming up, speaking of, we're going to talk about Reddit because it's paring gains a little bit right now, but that's after it soared 48% in its trading debut. We'll have the latest. This is Bloomberg. check in on shares of Reddit because, of course, they're falling a bit today, but that's after they surged nearly 50% in their trading debut yesterday. And the IPO, which raised $748 million, it's the fourth largest U.S. listing so far this year. For the latest, we're joined now by Bloomberg's Amy Orr. And Amy, I mean, just reflecting on yesterday, of course, what we saw, it feels like by most measures, this was a success.
Yeah, it is. And especially given the fact that it sold 8% of its offering to Redditors, essentially, to its users, under the direct share program. And if we look at history, it didn't fare very well. If we look at Deliveroo, if we looked at Facebook during its early days, Deliveroo was down 30% on its debut. And Facebook went through a phase of like losing half of its value in the first 3 months before kind of rebounding to where it is. So essentially, Reddit is actually doing very well comparatively.
Yeah, and it's going to be interesting, of course, to see how the next week and all the weeks after that go. But what's interesting, it feels like in some ways we're back to 2021 because, of course, with the big pop that we saw yesterday, Reddit's valuation is back or very close to that $10 billion valuation that they had about 3 years ago.
It definitely chose the right time to go public, but I wouldn't say for the market in general that is back to 2021, given the IPO market was red hot during 2021 where $330 billion was raised, and now we've only got $9 billion of IPOs raised so far this year. But the sentiment is much better with Reddit now still holding up well above its $34 IPO offer price. So I think the sentiment is for people to be more optimistic, especially issuers lining up to go public in the second quarter or later on this year. But we have to be reminded that there is an election coming in the second half of this year, and there's going to be volatility in the market.
Absolutely. Unfortunately, for better or worse, it's pretty hard to forget. But Amy, I know you've had a very busy week. Really appreciate your reporting. Our thanks, of course, to Bloomberg's Amy Orr. Now, still with us, we have Greg Bowdle. He is head of U.S. equity and derivative strategy over at BNP Paribas. So, of course, when it comes to talking about Reddit, the conversation that I keep having is that this is great news for the pipeline. All of those IPO candidates waiting to see how the market receives, of course, some of these IPOs. But you take kind of the other side of that.
Yeah, I mean, it's not so much that we take the other side for it. We think it's interesting, but I'm just not sure how much of a read across there is for the broader market, risk sentiment. We're in an environment where equities have rallied a lot this year. We can see plenty of evidence of exuberance. So a small name being listed, having a great IPO is nice, but I'm not sure that there's a bigger read across the market.
There's not a huge takeaway, of course, a life-shattering revelation. It's a good counterpoint, of course, to what we're hearing. And I think when you mention all the exuberance that we have seen so far, I mean, you can just take a look at the chart of Bitcoin. I guess the more surprising thing is that we haven't seen the IPO window open up more meaningfully.
Yeah, I think it's certainly the analogy to 2021. We can certainly see that in some of the secondary markets in terms of many of the positioning indicators that we look at. They do look very similar to the first half of 2021. So there are those similarities there. I guess the big difference is now the monetary policy backdrop.
And I do want to get existential for just a minute or so, because you and I were talking in the break about the concept of de-equitization, of course, the fact that you take a look at equity markets and they've actually been shrinking a bit. And what I've been trying to work out is that's a really interesting trend, but is that something that we need to care about?
Yeah, I think it's a super important driver of the U.S. equity market. The buyback story has been very important for a long time. The question really is it sustainable? And I think the answer for a long time for U.S. buybacks that are very driven, particularly by large cap tech names with great balance sheets and amazing free cash flow profiles, is that a lot of it is sustainable.
A lot of it is sustainable, especially if you have a big, beautiful balance sheet. But let's circle this conversation back to those mid-sized, those smaller companies that we were talking about before the break. Because, of course, in addition to Reddit's IPO, we had a Fed meeting this week. We got a dot plot, and the longer-run median dot was raised to 2.6%. That's up marginally from 2.5%. If we are heading into this higher for longer environment, I know that in and of itself is a subject for debate. What does it mean for some of those smaller companies with shakier finances?
I think it creates a challenge, and you can see it very clearly in the price action that whenever you have a CPI print or a Fed meeting, what is the most reactive U.S. index? It's the Russell, it's the small and mid caps. So we saw it in November and December where the Russell had a 20% rally when the Fed pivoted. People got very constructive. We sent out something at the back end of last year saying that we effectively think the market's got ahead of itself here. And the Russell has really lagged this year, and it's really lagged as some of those very aggressive cuts that were priced in at the start of the year by the Fed have started to evaporate a little bit. So we saw it again this week, that with a relatively dovish message from the Fed, we saw Russell again outperforming this week, but it's something we're a bit nervous about how that kind of continues, and we think in a more normal rate environment, the fact that you've got 1/3 of the Russell that are loss-making corporates, there's more challenges in terms of the balance sheet there, certainly relative to the large caps.
Well, it's interesting, even though, I mean, we've been talking about a lot of these dynamics for a while, and the fact that you do have a lot of loss leaders in the Russell 2000, it feels like we haven't seen a really meaningful uptick in defaults and bankruptcies a little bit, but not, of course, anything that would cause a panic.
Yeah.
When do those higher rates really start to crunch some of these about?
Well, I think you don't have to get that bearish and think about a default cycle or a recession. You can just say if you move into a more normal environment and you have a corporate that has to refinance and has debt, and particularly those which are not turning a profit already, and that becomes an incremental stress. Doesn't have to result in a credit event, but it just makes it much harder to grow your earnings. And when you look at earnings momentum, it's very strong in the large cap names. We know AI is a big part of that. You look at earnings momentum in the small and mid caps, and not so much.
And can we just end on sort of a meditation on what higher rates mean for big tech? Because, of course, one of the narratives out there was that when you have higher rates, interest rates rising, yields rising, that would really pressure big tech. That hasn't happened. In some cases, it feels like a benefit. I mean, what truly is the relationship? How do you think about it?
Yeah, so it's definitely changed, and it's very interesting. So on a technical level, if you look at the NASDAQ relative to the Russell, and you look at those relative to rates, the correlation of Russell relative to NASDAQ relative to rates is lower than it has been in the last 20 years. So something has changed. And what has changed is the way the market's looking at the narrative. I think originally when the Fed started hiking, people thought about it from a fundamental perspective. Discount rates. You discount these future cash flows for tech at a higher level, therefore they're worth a little less today. But the thing is, the fundamental backdrop has been so strong for tech that we're seeing these earnings upgrades that it just hasn't had that much impact. But the other impact of rates is a more direct fundamental impact. If you're a corporate who has debt on the balance sheet, you're a lower quality corporate, and those interest costs are rising, that has a more direct fundamental element. So it's really switched from a valuation, what you might think of as a duration story, to a kind of refinancing quality type story.
Okay, really interesting stuff there. Unfortunately, Greg, we have to leave it there. So enjoyed this conversation. That, of course, is Greg Boudel of BNP Paribas. Thank you so much. Now, still ahead, we're going to take a look at the companies making the most social buzz today, and that's our Social Climber segment up next. This is Bloomberg. right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, we have United Airlines. It's now letting people pool and share their frequent flyer points with family and friends. The carrier will allow groups of up to 5 Mileage Plus members to share and redeem miles from a joint account. It's a feature that's offered by some of the smaller carriers like JetBlue and also Air Canada. Next up, talk about fast food on the fly. Wendy's, it's delivering food by drone for the first time in Virginia. It's part of a collaboration between DoorDash and Alphabet's food delivery company called Wing. So Wing drones, they fly eligible items, including burgers, fries, and Frosties, at 65 miles an hour before gently, apparently, dropping them off on a customer's front lawn. The pilot service is said to expand to other U.S. cities before the end of the year. And finally, the demand for the diabetes drug Ozempic. It's causing a lot of stress for workers at the Danish drug maker Novo Nordisk. The CEO said that over 14% of workers reported stress symptoms last year, a figure that he says is too high. Now, work-life balance, it's a vital part of the culture over at Novo, with many of the employees going on vacation for the month of July. Meanwhile, the GLP drug, it's also said to be making news after reports of its impact on fertility. Some women reporting that they're pregnant, in most cases unintentionally, while taking weight loss medications such as Ozempic, despite being on birth control or dealing with infertility. So a lot to unpack there. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Coming up, we're going to be speaking with Simon Freakley. He is the CEO of Alex Partners.